Well, it's getting late. I can see the excitement draining from people's faces right in front of my eyes here. And we're yet another group that's going to talk about what's going to happen with stablecoins as it matures. And I thought the last panel, actually the last two panels, are very good. So rather than repeat that, I think let's talk about it a little bit. So I'm Hans Morris. I'm a managing partner at Nika Partners. We're a fintech VC. My background was really mainly with big companies like Citigroup and Visa, and Nika is about 11 years old, and I think we see ourselves as being between the financial system and innovation. We do lots of enterprise investments, and in the crypto space, our whole thesis is around, if you believe, as I think everyone here does, that this is going to be a core part of the financial system, then what infrastructure is necessary? So that's what we believe, and we're an investor in Zero Hash. And Edward, and I think you can credibly say that Zero Hash is one of the 2 or 3 leading companies that are at that intersection. Basically, that abstract away all that complexity with some really well-designed APIs, enable companies, payment companies, banks, wealth managers, others, brokers to have an efficient intersection with the crypto ecosystem. And Edward has a great background, both as a trader, entrepreneur, master's degree from MIT, and he's British. So whenever he says something, he just sounds more authentic and responsible than most other people do. So welcome.
Thank you.
All right. So why don't you, let's talk about, why don't you give some examples of your current clients? And you have like 75 or 80 different clients around, and some very big ones. But why don't you talk about, okay, what are the applications, use cases that are most common? And then let's talk about what we want to get to and what things need to look like for that to happen.
Yeah, absolutely. So at Zero Hash, we founded the business in 2017, so we've been around for some time and seen a lot of evolution. But as Hans said, our goal is to abstract away all the complexity, both from a technological and regulatory perspective, of cryptocurrencies and stablecoins. And really, we have 3 key theses. One is that stablecoins and crypto will disrupt the way that payments is done. And for example, we power groups like Stripe and Remote.com and others that have built payout products. So effectively paying people instantly, cheaply, immediately with stablecoins globally. We also power brokerage use cases, so the store of value thesis around crypto. We power groups like Interactive Brokers, a firm that's $75 billion, and they entered the crypto space early with us. And then we have our tokenization piece, and today we've heard quite a lot about tokenization. But I think one of the key things around tokenization is how do the payment rails keep up? And that's effectively where Zero Hash comes in. For example, last week, we bought over $500 million of stable coins into tokenized money market funds, such as Biddle and Benji. So really our goal is to make this technology more accessible, both from a technological and regulatory perspective.
And I think this is an important point, because the last couple of panels have both talked about regulation, and I do believe, essentially, everything in financial services is regulated for a good reason, because there's lots of governments care a lot about well-functioning systems. If you have a dysfunctional financial system, then it has huge impact on the economic efficiency of any economy. And one thing that's worth noting here, we'll talk about this, when you're talking about money movement in cash, short-term investments, for example, that is pretty much a zero-risk environment for corporations and financial institutions. In other words, transactions are modeled. Everything is set up so it's zero risk. So when you introduce operational risk, you introduce regulatory risk, you introduce higher risk of fraud and scams and stuff, it makes it basically, it's not acceptable. It's not a, well, we're pretty good, we're 92%. It's 99.9999%. You can't say, well, we're down a lot, there's some regulatory risk we're taking, it's not clear that we're going to have liquidity when you need it. All that doesn't work for any of these types of payment environments. So you've taken the regulatory route from the beginning, and you want to describe how you approach that? Start with regulation. We'll talk about some of the other points in a second, too.
Yeah, so I mean, the way that we view regulation is that it's really the floor in terms of how we should think about things. I mean, we really prefer to talk in terms of trust, and that's effectively why institutions have leveraged us. I think you're right. I mean, in terms of how people think around stablecoins, there are risks, right, that you have to think through. For example, effectively right now, if you hold USDC, you to some degree are taking credit risk against Circle, for example. There's also blockchain risk, right? We now have stablecoins across 15 plus different chains. There are risks associated with different blockchains being down, and you start to think about the complexity around smart contracts. And then you start to think about the regulatory challenges. And that is why we're very excited by the stablecoin bill that, I think at this point there is broad bipartisan support. There is a clear executive mandate to get that passed. And that will effectively make it easier for banks and other FIs to adopt stablecoins. What excites me about that, often I think people say, well, big companies doing things in stables, that in and of itself is interesting. For me, that's not what's interesting. It's the distribution of this technology now to hundreds of millions of people. And that's what makes it really interesting, is effectively, today, most people in this room have access to a stablecoin wallet. Most people in New York have access to a stablecoin wallet. If you think of Revolut, Robinhood, PayPal, Venmo, more broadly in the world, Nubank. Once you allow banks to do that, that number goes from however many hundreds of millions of people that have that accessible today to effectively 100% of the market. So now you have this technology that is distributed. And then you have to think about usability challenges, cross-chain functionality, all these sorts of pieces. But I think that's what's the unlock from big financial institutions entering the space, is the distribution of this technology, and then that allows for applications to be built on top of it.
All right, so let's talk about some of these applications. One data point that I like mentioning to people is that average B2B transaction volume is about $220 billion per day. So when we talk about, and right now I'd say approximately zero of that is through stablecoins. It doesn't work very well right now. Is that going to change? And one thing is regulatory clarity, and I think that will definitely help. Second thing was at the panel, 2 panels ago, which I thought was a very good point, which is yield. If you're a business, big business, you definitely care about maximizing your liquidity and spend a lot of time looking at hedging, optimizing your cash, making sure money is where you need it to be to reduce borrowing costs, make your capital efficient. So having any of your cash in a zero-yielding asset is antithetical to that. And same thing with small companies too. And now as cash costs, it's one thing when short-term rates are zero, when they're 4% or something in US dollars, that's a real cost. So you're going to have to move from stablecoins into some sort of local a security or something that will earn a return. What do you think about that fundamental issue?
Yeah, so I think maybe just taking a step back, I think right now, we heard from Franklin Templeton, we heard from different players. For example, in the what people call the tokenized money market space, effectively, for lack of a better term. But the way that I break down the stables landscape is that we have stable coins and then we have stable instruments. And stable coins are effectively, USDT, USDT, RLUSD, and then we have stable instruments such as BIDL, Benji, etc. And right now, the differentiation is largely that stable coins are much more transferable, they're programmable, and largely in the US, they are non-yield bearing. If you look at stable instruments, they are yield bearing, but they happen to be a security, and they are less transferable. For example, Benji really cannot be transferred out of the walled garden. And so these are the core differences right now within the stable landscape. I do think the two worlds become, I think we just start to conceive of stables. So outside of the US, there are yield-bearing stable coins. And then I think if you follow this through, if you look really closely at the stablecoin bill, there is a carve-out saying that stable coins are not yield-bearing instruments. That clearly has been introduced by certain political aspects. But, somebody earlier today said if it's yield-bearing, it equals a security. That's a really weird way of thinking about it. If banks themselves can issue stable coins, why can they not earn interest on that stablecoin? Right now, in my checking account, I can earn interest. So this is just another way. It's another way of thinking about what an account is, what these pieces are. So I do think that we do get to a world where stable instruments are yield bearing. Right now, we draw this artificial distinction between tokenized securities and not. Paxos, for example, was launched. GEL. There's too many acronyms now, but there are yield-bearing instruments, and I think that the world combines. And I think, hopefully, to your point, one of the benefits of stablecoins is reducing the cost of capital, but that's massively impinged if you can't earn interest on it.
Yeah, I mean, in some ways, I would say you don't care. I mean, it's just digital assets and making that efficient, and I think a lot of this will shake out, and what instruments actually, and I think really what most corporations, like any of you, if you had an intelligent system that was optimizing all this 24/7, you would say, I want to understand the risk I'm taking, I want to understand the settlement time period and my alternative cost to capital in that, and you want to understand the cost of that transaction. You want all those to be very transparent and then be able to decide between those. And we'll talk about the risk in one more second, but I think, I feel like, okay, well, there's going to be a lot of shaking out, and that's lots of alternatives, which means the intelligence layer that you or someone else is going to need to provide is an important part, because most businesses are going to say, I don't have all the ability to get into that and assess all those risks real time when there's lots of fraud and other things, which we're going to come to in 1 second. We're going to talk about fraud in 1 second. So.
No, I mean, I think to your point, there's two things that will be true in this space. There will only be more stablecoins, and there'll only be on more chains.
Right.
And so therefore, the fragmentation and complexity increases. And making customers choose between different stablecoins and different chains doesn't really make sense from a usability standpoint. So I think this is where you start to think about cross-chain, cross-asset, cross-instrument, and that's really where we're spending a lot of time, is solving those usability challenges. I think we've solved the distribution of this technology challenge at this point, in part with help with Zero Hash. Now it really is a usability challenge that will come up now that we've ticked off the technology complexity, the regulatory complexity, hopefully by the middle of this year. Then it becomes a usability challenge.
Yeah, but I think to me, what Zero Hash and other entities like that, to me, even very sophisticated companies, and I can tell you that in the last week I've spoken to Treasury and payments heads at 3 of the Fortune 20 companies, very sophisticated companies, and their view is we're looking at this, but what I said at the beginning, the zero risk world, we're a long way away, and that I think, there's going to be a role for abstracting away all that complexity and saying, we are managing all that complexity for you. We are helping you make just decisions that are within the risk profile that business wants to take. So let's talk about fraud, because one thing that is you see it everywhere in payments is sophistication of fraud continues to increase, and it's an intelligent agent of its own. You put in infrastructure to protect it, and it mutates and finds another weakness. And if we live in a multipolar world, for example, where everyone is potentially stealing money from everyone else, including governments and stuff, then what's your view on the risks associated with digital assets and stablecoins in that, where you have immutable, non-recoverable transactions that are real time? How will that work? How will that ecosystem evolve to manage that risk?
So I think maybe I'll start very tangibly and then go maybe a little bit more ethereal. So very tangibly, there is huge benefits of irreversible payments if you're a merchant effectively. So one of the products that we've launched is account funding. So if you're familiar with Kalshi, they are an events-based trading marketplace where you could bet on the election. You can now bet on March Madness, for example. These things happen over the weekend where banking rails don't keep up. But really one of the biggest unlocks that people don't truly appreciate is the fraud construct. The amount of fraud, if you don't know a customer, they're onboarding tens of thousands of clients a week. If you can't build a fraud profile on that customer, you have to have very low limits. And so if you open up an account today at Kalshi, you have a $2,500 limit. With Stables, you are uncapped, effectively. And the reason for that is because it's irreversible. There's no chargeback risk. So from the merchant's perspective, there's a huge amount of opportunity. I do also think that there's maybe taken up a level. If you think about what you can do with identity on chain and building up profiles, that can be really, really important from a fraud perspective. So one of the things that Zero Hash does is that the average customer at Zero Hash has effectively three accounts. They come through 3 different profiles. So a customer, for example, Hans might be a customer at Stripe. They might be a customer at Kalshi. They might be a customer of Blockworks Bidor Fund. So we see you 3 times. So we've done a lot of things around effectively building up a profile so that if you do something wrong over here, we prevent you from doing something wrong over there. But I think that's a very centralized way of thinking through identity. So I think as you think about on-chain identity, as we move from a read, write, own construct, I think there's a lot that can be done. Because we were talking the other day about banks sharing fraud data. A lot of the big banks don't want to share the data. But the beauty of a blockchain is that this can be solved in effectively in kind of an online identity construct.
Okay, so we don't have too much time left, so I'm gonna rattle off a few things which I think are conditions precedent for broad institutional adoption of all kinds of digital payments, whether they're stablecoins or other outside of the current ecosystem, which are wires and network schemes and stuff and local settlement schemes. So one is we've discussed already regulatory clarity. Second is that there be a clear set of rules on reversibility of transactions, or how you can govern screw-up risk, or what is that mechanic going to be. There's a lot of concern, even big businesses and small businesses, about just operational risk. Like, how can I assess this stablecoin versus that stablecoin, this crazy, the hundreds of different custody solutions, some of which are software-based, some of which are regulated, trying to navigate that. How do I make sure that I can get yield and get access to yield so there's enough liquidity to settle into a yield-bearing asset, or where I need liquidity in some jurisdiction? How do I also monitor the stability of the network under which this is actually getting transacted, and the risks I'm taking and executing on that specific network? So these are examples, and counterparty risk is the term that you use in financial services, and this is continuously monitored. How can you set up an automated basis for doing that? So that's, in some ways, that's good news for you, because there's a lot of infrastructure that Zero Hash can provide to enable that. But given all this, if I said $220 billion a day is B2B payments, how much of that do you think in 2 years is going to be in digital asset movements?
Yeah, I mean, I hate providing forward-looking statements because you're always wrong by a multiple. So,
well, you can either pick the year that you'll be 10%, or you can say what percent will you be in 2 years.
I mean, I think it'll be soon. Material numbers, and I think there's a couple of reasons for that. One, I think we've solved to my point, right? We've solved the regulatory challenge, some of these other pieces as well. Especially if there's clarity. I think when you think about B2B payments, one of the challenges of B2B payments is that they're irregular and large, and the cost of holding money for these remittance companies is huge. And so I personally am more excited about the B2B use case as opposed to B2C use case or C2C. And the reason for that is C2C, effectively, you can hold float balances, it's very predictable, you can effectively internalize. It can be relatively cheap. There are definitely optimizations. But B2B payments are very different to that. Large, irregular, complex jurisdictions. And so I do believe, when you think about B2B, often we think about one business paying another. B2B could also mean treasury movements between companies as well. So I think there's a huge opportunity there. And we're starting to see this. Moving funds out of certain countries can be incredibly challenging, costly, and effectively the scale of them stablecoins in some ways serve better the B2B use case than the consumer use case for remittances.
I agree with that. It will. I just think the time, and one thing on regulatory clarity is, like, even if a bill passes in August, which is what they're, the current estimate, you still then have regulations that have to be written. A lot has to happen. So I think the regulatory clarity will take longer to infiltrate, but it will create more inevitability. I think more willingness, and I see this right now. Business is saying, we need to start figuring this out, looking at this, deciding what our priorities are. Versus, like, we don't care, which I think was pretty much the universal answer last year. I think that's it. All of you look much more energized than you did about 20 minutes ago, and we're going to let you get back to texting and all the other things you'd rather be doing, but thank you all for paying attention. All right?
Thank you, Hans.